If you are wondering what tax bracket you fall in, you need to watch this.
Hello and welcome. Let's get straight into it, shall we? We're going to start with a number you won't find on any official government table, but one that could be costing you thousands of pounds.
60%. Yep, you heard that right. It's an income tax rate that is very, very real. And with some pretty big changes coming down the track for 2026, it's a hidden trap that's going to catch more and more of us out. To help us get our heads around all this, we're using a full breakdown from the tax experts and my tax accountant.
So, the big question is, could this be you? Could you be paying this 60% rate without even knowing it? Well, as wages creep up and those tax thresholds stay frozen solid, it's more likely than you think. In the next few minutes, we're going to help you figure it out.
My tax accountant has laid out exactly what's changing, who is most at risk, and, this is the important bit, what you can actually do about it. So let's get started.
Here's what we've got on the cards. We'll start with the key tax alerts for 2026. Then we'll really unpack that £100,000 tax trap. After that, we'll look at some changes for investors and landlords. And then, the good stuff, how to actually reduce your bill. We'll also have a quick look at Scotland's unique system before we wrap up with what to do next.
So what's really going on here? Well, it all comes down to something called fiscal drag. Now just imagine you're at the airport on one of those moving walkways. Your salary is you, walking forward. But fiscal drag is the walkway itself, pulling you along even faster, right into a higher tax bracket. Because wages are going up, but the tax thresholds are frozen, more of our money is getting taxed at a higher rate. It makes proper tax planning absolutely critical.
And this brings us right to the heart of the problem, the £100,000 income tax trap. This is the sneaking mechanism that creates that 60% tax rate we started with. And you'll want to hear this part, because it catches so many people completely off guard.
Okay, first, just a quick refresher. Your personal allowance. It's simply the amount of money you're allowed to earn every year before the tax man takes a penny. For the 2026 to 2027 tax year, that figure is £12,570. Simple, right?
Well, not quite. The rules of the game change once your income crosses a very specific line. So what actually happens when your annual income tips over that £100,000 mark? This is where it gets a bit tricky.
Right, here's how the trap works. As soon as your income hits £100,000, your lovely tax-free personal allowance starts to shrink. For every £2 you earn above that mark, you lose £1 of your allowance. And by the time your income gets to £125,140, poof, your entire tax-free allowance has vanished.
So, what does that mean in real money? It means you're not just paying the 40% higher rate of tax on your extra earnings. Oh no, you are also paying 40% tax on the bit of your personal allowance that you just lost. You add those two things together and you've got yourself an effective tax rate of 60% on that slice of your income. It really is a nasty double whammy.
Let's break this down with a real-world example. Say you're a freelance coder in Manchester. You have a great year, and your income goes from £100,000 up to £110,000. That's 10 grand extra. Brilliant. But look at the numbers. You'll pay £4,000 in tax on that extra 10 grand. But here's the sting. Because you're 10,000 over the threshold, you also lose £5,000 of your personal allowance. That lost allowance is now taxed at 40% too, which costs you another 2 grand. So that £10,000 pay bump just landed you with a £6,000 tax bill. That's a 60% tax rate. Ouch.
And look, this isn't some rare thing that only affects a handful of people. Just look at this chart. The number of people getting caught in this trap is on track to nearly triple between 2017 and 2029. We're talking about it going from 300,000 people to a forecast of 850,000. It's a direct result of those frozen tax bands we mentioned earlier. Now, it's not just high earners from work who need to be paying attention. If you've got income from investments or from property, there are some pretty big changes headed your way as well. Stay with me. This next part is absolutely crucial for business owners and property investors.
From April 2026, the tax you pay on dividend income is going up by 2 percentage points for most people. And remember, the tax-free dividend allowance is already tiny, just £500. This change is really going to be felt by small business owners who often pay themselves through dividends.
And it doesn't stop there. A year later, from April 2027, the exact same thing happens to the tax on your savings income. Every single band is going up by 2 percentage points. This will affect any interest you earn from savings that aren't tucked away inside an ISA. And for landlords, this is a biggie.
From April 2027, we're seeing the creation of completely separate and higher tax rates just for property income. Your rental profits won't be treated the same as your main income anymore. Instead, they'll be taxed at these new, higher rates. This is a huge shift that every landlord needs to get ready for.
Okay, so we've laid out the problems. But it is not all doom and gloom. The really good news is that there are perfectly legal, smart ways to manage your income and lower your tax bill. This is the part where you can actually take back some control.
So let's look at 3 ways to beat that 100K trap. Honestly, the most powerful tool in the box is making pension contributions. This lowers what HMRC calls your adjusted net income. So back to our developer earning £110,000, if they put just over £8,000 into their pension, it could bring their adjusted income right back down to that 100K threshold. And that means they get to keep their full personal allowance. Simple as that. Making gift date donations to charity works in a similar way. And finally, some employers offer salary sacrifice schemes, where you can swap some salary for benefits, which also helps.
You know, the tax specialist Nikki Patel summed it up perfectly. She said a great year on paper can have a nasty sting in the tail at tax year end. And that's so true. This is why planning ahead is absolutely vital, especially if you do a bonus or a pay rise.
And here is a fantastic tip from the experts at My Tax Accountant, one that could save you a serious amount of cash. You can actually look back over the last 3 tax years. If you didn't use up your full pension allowance in any of those years, you might be able to carry it forward and make a much bigger tax-friendly contribution right now. It's a brilliant tool that so many people miss.
Now, it's really important to remember that tax in the UK isn't the same everywhere. North of the border, Scotland has been doing its own thing with income tax for a few years now. So let's have a quick look at how different it is up there.
As you can see, for 2026-27, Scotland has a much more complicated system, with 6 different tax bands. You've got a starter rate, an intermediate rate, and even a top rate of 48%. The main thing to know is this. For this tax year, if you earn less than about £33,500, you'll actually pay a bit less income tax in Scotland. But if you're a higher earner, you will pay quite a bit more. It just goes to show where you live really can make a difference.
Phew. Okay, we've covered a lot of ground there. From that 60% tax trap all the way to the different tax systems across the UK. The whole landscape is definitely getting trickier to navigate. So let's turn all this knowledge into some clear, simple actions.
If you only remember 3 things from today, please make it these. Number 1, that 60% tax trap is real, and it's catching more and more people every single year. Number 2, taxes are going up on dividends, savings, and property income. And number 3, the most important one, taking action, planning ahead with things like your pension can make a huge difference to your final tax bill.
Right, before we finish, a very quick but very important disclaimer. Everything we've talked about today is for general guidance only. Tax rules are incredibly complex, and they do change. Your own situation is unique, so please don't rely on this alone to make financial decisions.
So the final question is, after hearing all that, are you ready to take control and make sure you're not paying a penny more in tax than you absolutely have to in 2026?
For proper advice that's tailored just for you, we really do recommend you get in touch with the experts at My Tax Accountant. They can help you make sense of all these changes and build a plan that's right for you. Their details are on the screen now. And of course, please do subscribe to the channel for more updates just like this one. Thanks for watching.